What's the best trading strategy? Part one. Now, in this video, we're going to talk about profit, and the answer I give might not be what you think, because this is a question I get all the time. I get lots of traders coming to me saying, what's the best trading strategy? And actually what they're asking me is, what is the most profitable? What's the most profitable strategy you trade, your members trade? What's the most profitable strategy you've had over the last 10, 15, 20 years? And the challenge with that question is the idea that profitability is the only marker you choose is where a lot of traders slip up. So we're going to do a little thought experiment here. Let's say you've got two traders. You've got trader A and you've got trader B. Trader A has only been in the game for about 3 to 4 months. They're learning the basics of trading. They've started executing. They've got a strategy, but unbeknown to them, that strategy shows a high level of profitability on paper. It's got an edge. It has a distribution of trades. They can actually see that process in front of them. But the problem is that trader has looked at the win-loss ratio, and that strategy, this is a little extreme, but that strategy is only winning 20% of the time. And what that trader's done is convince themselves that they can cope with the number of losers that strategy has on average every 10 trades, every 20 trades, every 30 trades, every 100 trades. And the challenge that trader has is they think they will be able to cope with the inevitable losers that strategy has. And then when the winning trades come along, they will have the capacity to be able to hold those trades for 10R, 12R, 15R, the much higher reward to risk ratios that strategy has. Whereas the reality is that trader's level of experience will make it very difficult in those early days for them to do it. Whereas you've got trader B on the other side, and trader B started with a strategy that wasn't as profitable as the strategy that trader A is looking at, but that strategy had a win-loss ratio that was nearer 50-50. So they were winning the same amount of time they were losing. And they weren't going for big R values, so 15R or 12R, big reward values. They were going for a consistent 2 to 3R on every single trade. So they were winning around the same amount of trades as they were losing, but on their winning trades, they were winning at least twice as much. And they started that way. They built up the resilience for that, and they built up the consistency. And then when you look at the two strategies on paper, the strategy that trader B is trading is less profitable overall. If you looked at the equity curve goes from starting point here, and as you go up the equity curve, it gets to a profitability level that is much lower than the strategy that trader A is trading. Trader A's equity curve is way more jagged. But the problem is, and here's the irony, is the strategy that is probably best suited at this point to trader B, now that they've built up the resilience, could be the strategy that trader A is trading, because they built up the resilience at a lower risk to reward ratio and a better win-loss ratio. They've now built up that resilience. They're stronger, they're more capable. They would have the ability potentially to trade the strategy that has a lower win-loss ratio, but has the higher R values. Whereas the irony is that's the one that trader A is trading, because they've looked at it and seen it's the most profitable and convinced themselves that even though both strategies have an edge, that I want to go for the one that's going to make me the most money. So actually, in that scenario, what trader A should be doing is looking and saying, how can I build up resilience and make sure that I don't just simply look for the strategy that is the best performing strategy. I look for the strategy that I can trade. And one of the things that I do when I'm coaching traders is I get them to look at the capacity of any particular strategy that they're trading. So they look at the profitability, they look at the win-loss ratio, and they look at the risk-to-reward ratio. If the trades themselves have a variable risk-to-reward, we look at the average risk-to-reward on their winners. And let's say, for sake of argument, it's 3R. And their win-loss ratio is 60-40, or 40-60. They're winning 40% of the time and they're losing 60% of the time. On paper, that's profitable. But what we want to see, and we want that trader to see, and what I want to see when I'm working with them, is what is the difference between the reality of what they trade and the capacity of what they trade. So the capacity is the performance over the strategy over a given period of time, a month, a year, 5 years, whatever it is. That's the capacity. The reality, what we call the actual performance, is what the trader is able to do. And then what we can measure is the key variable, which is their trade adherence. And if you're listening to this and you've got a strategy that's profitable, but you can't make it profitable, then it's highly likely there is an issue with trade adherence. So it could be that you are taking the trades, but after a couple of losers, you get fearful, and maybe after 3 or 4 in a row, because that happens on that strategy, you get fearful on that 5th trade and you don't execute on that trade, and that's the trade that's going to bring in 5, 6, 7R, because you aren't able to deal with the inevitable losers that the more profitable strategy has, but the higher risk to reward that's needed. So if you can see that you keep missing those critical trades because you become fearful, then what you can do is start to look at what are the triggers that are causing that. Because what it could be is very simply that you start listening to the news, or you start listening to something that you normally wouldn't, or you add in another variable or indicator, because what you're craving on that 5th trade is you're craving certainty, because you haven't been able to deal with the losers that you've had. And on top of that, maybe that's not the issue. Maybe you execute fine on the trade, but what you're not able to do is run that trade for long enough to actually get it to the R value that makes that strategy profitable. So it could be that you bail out of the trade too soon. Yes, you've got the intention of running it to 4R or 5R, but as soon as it hits 2R, you bail out the trade as soon as it goes against you a little bit, because the fear then is about the trade rolling over and being another loser that you have on top of the losers that you've already taken. So it's these critical moments that could be that strategy at this point, you haven't built up the resilience, or it's not the right strategy for you relative to where you are in your trading journey. But you'll only know that if you're measuring the capacity of that strategy versus the reality of that strategy, and looking at your trade adherence and essentially saying, how big's the gap? And what is it that is causing the gap in the first place? What we're going to talk about in the next video is time, a consideration that a lot of traders don't think about when they're looking at a strategy. And if you're interested in how me and my team can help you, check out the links in the description.